The global stock market is in turmoil, and electric vehicle manufacturers are right in the middle of the storm. This downturn is being driven by a number of factors, including escalating tariffs on imported vehicles in the US and widespread global economic uncertainty. It's a challenging time for investors, but it might also be an opportune moment for those looking to take advantage of deeply discounted stocks in the EV sector. Across the board, share prices are collapsing. This isn't limited to a few companies, it's widespread. Tesla, BID, Xpeng, NIO, and other major names in the EV space have all seen steep declines. But as Warren Buffett once said, be fearful when others are greedy and greedy when others are fearful. The question now is whether this moment represents a once-in-a-decade opportunity. Tesla stock has taken a hit in recent days, with after-hours trading pushing it down to around $235, a 6-month low, barring one isolated instance. This significant dip is drawing attention. But Tesla is no longer just a car company. Its future rests increasingly on other projects: autonomous driving software, energy storage solutions, robotics, and AI. While car sales continue to drive revenue, Tesla's long-term success may hinge on its ability to deliver on these technology-focused ventures. That's why this downturn in stock price may not necessarily reflect the company's true value. It could present a strategic opportunity for investors who believe in Tesla's long-term innovation roadmap. The stock is at a relative low. When emotions are high and confidence is low, that's often when the best decisions are made. Tesla isn't alone. Chinese EV manufacturers continue to see their price shares tumble as well. BID dropped 12% overnight, NIO fell 11.3%, Xpeng fell 11.4%, Li Auto dropped 11%, Zeekr has fallen 25% over the past year and around 30% in just the past month, plummeting from $33 in mid-March to around $21 today. Take Zeekr, for example. Despite the dramatic price drop, the company has significant upside potential. Zeekr now owns Lynk & Co., a premium plug-in hybrid brand under Geely Group. Lynk & Co. vehicles are well regarded in China, offering strong design and quality. This merger gives Zeekr access to a pipeline of high-quality vehicles that could prove critical in differentiating the brand from competitors. Lessons from past investments. Looking back, some investors who bought into NIO and Xpeng a few years ago saw promising momentum early on, but the landscape has changed. NIO has struggled to maintain its growth trajectory, while Xpeng has surged ahead. Xpeng's resilience is notable. In fact, Xpeng has posted record sales for 6 months straight and has gained serious recognition from global players. Volkswagen's investment in Xpeng is a major endorsement of the company's technology, particularly its EV platforms and software systems. Volkswagen could have partnered with NIO but chose Xpeng. That speaks volumes. Xpeng's stock price has jumped 163% over the past year, driven by strong performance, new vehicles launched, and investor confidence. Their expansion plans are ambitious and global, and the company's financials are steadily improving. In fact, by the end of this year, Xpeng may become one of the only EV companies in the world to turn a profit from selling electric vehicles, joining Tesla in that exclusive category. There's growing consensus that the EV industry, particularly China, will undergo significant consolidation. Xpeng's CEO has even predicted that only 7 EV manufacturers in China will survive the current competitive environment within 5 years. That timeline may be debatable, but the underlying message is clear: a massive shakeup is coming. The companies most likely to survive and thrive will those be with strong fundamentals, global strategies, and innovative technology. Based on current trends, the top contenders are Xpeng, expanding globally, improving financials, and backed by a major automaker; BID, dominating a wide range of price segments and supported by its battery business; Zeekr, enhanced by the Lynk & Co. merger with a growing lineup of premium EVs. Selling EVs in China alone is no longer enough. Success depends on global reach and adaptability. These 3 companies are scaling beyond borders and producing high-quality vehicles that can compete internationally. BID, for instance, has a massive car lineup that spans economy models to luxury EVs and even supercars. While the breadth of their offerings can be overwhelming, even for those closely following the brand, it's a sign of their aggressive expansion. They're not only one of the second largest battery producers globally, but also a rapidly expanding growing automaker. Their dominance is already showing. In Thailand, the second largest pickup truck market globally, BID recently overtook Toyota to become the top-selling brand. Considering Toyota's historical dominance in Southeast Asia, that's a historical shift, and a signal of what could happen in other emerging markets. The United States has imposed steep tariffs on imported vehicles in an attempt to protect domestic manufacturers from being undercut by lower-cost foreign competition, particularly Chinese automakers. However, the actual impact of these tariffs is more complex than it appears. While the policy may seem to target Chinese EV brands directly, most of the companies like BYD, Xpeng, and Zeekr don't yet have a significant market presence in the US. As a result, they remain largely unaffected in the short term. Instead, they're focusing on their expansion efforts on rapidly growing markets like Europe, Southeast Asia, and Latin America, regions where demand for EVs is accelerating. Ironically, the companies facing the greatest disruption from the US tariffs are not Chinese but Japanese and German automakers. Brands like Toyota, Honda, Nissan, Mazda, Subaru, BMW, Mercedes-Benz, and Porsche rely heavily on the American market for both profits and global brand positioning. These manufacturers are already under pressure to transition to electric mobility, and the added cost of tariffs could erode their profit margins and slow their ability to innovate at pace. With their EV strategies still maturing, many of these legacy automakers may find themselves squeezed between high production costs and intense price competition from newer, more agile EV firms that are expanding globally without facing the same trade hurdles. The recent plunge in electric vehicle stock prices reflects less about company fundamentals and more about the broader emotional climate of global markets. Investor sentiment has been shaken by a combination of political instability, shifting trade policies, inflation concerns, and fears about global economic slowdown. However, when fears drive decision-making, it often detaches market performance from the actual value and future potential of companies. Many of the most prominent EV players are still executing on strong business strategies. Tesla, for instance, continues to dominate EVs and energy storage sectors while investing in AI and robotics. BYD is leveraging its vertical integration and battery production scale to penetrate new international markets. Xpeng is rapidly expanding its model lineup and narrowing its financial losses, while Zeekr is blending cutting-edge design and performance to carve out a niche in the premium EV space. The divergence between fear-driven market behavior and strong company performance could present a rare buying opportunity for long-term investors. History has shown that companies that innovate through downturns often emerge as leaders during recoveries. As consolidation looms in the EV sector, only the most adaptable, financially resilient, and globally focused brands will remain. Those poised to survive and even thrive are not just about building cars, they're about building ecosystems, technology platforms, and future mobility solutions. Recognizing this during times of market panic could offer investors a strategic edge that pays off in the long run. While nobody can predict the future with certainty, the evidence suggests that the recent sell-off in EV stocks may be more about short-term emotion than long-term fundamentals. The automakers that continue to innovate, expand globally, and improve their financials are likely to thrive. Tesla and Xpeng are on the cusp of making EV profitability a reality. While BYD and Zeekr continue to expand their reach and product quality, these companies aren't just surviving, they're leading. In investing, moments of doubt can often become moments of opportunity. The EV industry is still young, still growing, and still evolving. For those with vision and patience, now could be the right time to act.